Money mistakes can be far more costly than most people realize. Even small errors in financial planning or decision-making can accumulate over time, ultimately costing individuals millions of dollars. In today's complex financial landscape, where investment options, retirement plans, and market fluctuations can be overwhelming, it's easy to make missteps with long-term consequences. In this video, we will shed light on some of the most common money mistakes people make and how to avoid them. By understanding these pitfalls, you can take proactive steps to safeguard your financial future and build lasting wealth. The choices you make today can either set you up for a prosperous future or lead to significant financial setbacks. The goal is not to scare you, but to empower you with the knowledge needed to make informed decisions. Before we dive in, please drop a comment saying, "My financial situation is constantly improving." Positive affirmations attract good things into our lives, so comment, "My financial situation is constantly improving." When I see your comment, I'll give it a heart. Now let's continue. Compound interest is often referred to as the eighth wonder of the world, and for good reason. It is a powerful financial concept that can either work for you or against you. Despite its importance, many people misunderstand how compound interest operates, which can lead to costly mistakes. At its core, compound interest is the process of earning interest on both the original amount of money, the principal, and any interest that has already been added. This means that your money has the potential to grow exponentially over time. For example, if you invest $10,000 at an interest rate of 5% per year, the interest earned in the first year would be $500. In the second year, you would earn interest not just on the initial $10,000, but also on the $500 from the first year, leading to even greater growth. However, the same principle applies to debt. If you have a loan or credit card balance with a high interest rate, the amount you owe can quickly spiral out of control due to compound interest working against you. Many people fail to grasp this, leading to a cycle of debt that becomes increasingly difficult to escape. One of the most significant financial mistakes people make is delaying investment. The earlier you start investing, the more time your money has to benefit from compound interest. Even small investments made early in life can grow into substantial sums over time, while waiting too long can significantly reduce your potential wealth. Consider two individuals. One starts investing $5,000 per year at the age of 25, and the other waits until they are 35 to start investing the same amount. Assuming both earn a 7% annual return, the person who started at 25 would have around $1.1 million by the time they turn 65, while the one who started at 35 would have only about $540,000. The 10-year delay results in a difference of more than $500,000. This example illustrates the critical importance of starting early. Even if you can only afford to invest a small amount initially, the power of compound interest means that time is your greatest asset. By failing to invest early, you miss out on the exponential growth that can occur over several decades. One of the most dangerous financial pitfalls is accumulating high-interest debt. This type of debt, commonly associated with credit cards and payday loans, can quickly spiral out of control due to the high interest rates often attached to them. When you carry a balance on a high-interest credit card, for example, the interest charges can add up rapidly, leading to a situation where you are paying significantly more than the original amount borrowed. Consider a credit card with an interest rate of 20%. If you have a balance of $10,000 and only make the minimum payment each month, it could take decades to pay off the debt, and you could end up paying more in interest than the original balance. High interest debt can become a significant financial burden, making it difficult to save, invest, or achieve financial goals. The key to avoiding this mistake is to be mindful of the types of debt you take on. Whenever possible, avoid using credit cards for purchases that you cannot pay off in full by the due date. If you already have high interest debt, prioritize paying it off as quickly as possible. This may involve cutting back on discretionary spending, consolidating debt at a lower interest rate, or increasing your income to make larger payments. Making only the minimum payments on loans or credit cards is another common financial mistake that can lead to long-term debt problems. When you make just the minimum payment, a significant portion of your payment goes toward interest rather than reducing the principal balance. As a result, it can take years or even decades to pay off the debt, and you'll end up paying much more in interest than if you had paid off the balance more aggressively. For example, if you have a $5,000 credit card balance with an 18% interest rate and make only the minimum payment each month, it could take over 20 years to pay off the debt, with total interest payments exceeding $6,000, more than the original balance. This is the essence of the minimum payment trap. It keeps you in debt for much longer and costs you significantly more money in the long run. One of the most fundamental aspects of sound financial planning is having an emergency fund. An emergency fund is a savings buffer that you can use to cover unexpected expenses, such as medical bills, car repairs, or job loss, without having to resort to high-interest debt or liquidating investments. Unfortunately, many people neglect to build an adequate emergency fund, leaving them vulnerable to financial shocks. Without an emergency fund, an unexpected expense can quickly derail your finances, forcing you to rely on credit cards or loans to cover the cost. This can lead to a cycle of debt and make it difficult to achieve long-term financial goals. A good rule of thumb is to have 3 to 6 months' worth of living expenses saved in an easily accessible account, such as a high-yield savings account. This ensures that you have a financial cushion to fall back on in case of emergencies. Insurance is a critical component of financial planning that provides protection against unforeseen events that could otherwise lead to financial ruin. However, many people either neglect to obtain adequate insurance coverage or fail to review and update their policies as their circumstances change. There are several types of insurance that are essential for protecting your financial well-being, including health insurance, life insurance, disability insurance, and property insurance, such as homeowners or renters insurance. Each type of insurance serves a specific purpose, and having the right coverage can make a significant difference in your financial security. For example, health insurance helps cover the cost of medical care, which can be exorbitant without insurance. Life insurance provides financial support to your loved ones in the event of your death, helping them cover expenses such as funeral costs, mortgage payments, and living expenses. Disability insurance replaces a portion of your income if you're unable to work due to injury or illness, and property insurance protects your home and belongings from damage or theft. Inadequate insurance coverage can leave you vulnerable to significant financial losses. For instance, if you don't have health insurance and you experience a major medical emergency, the resulting medical bills could be financially devastating. Similarly, if you have insufficient life insurance, your family may struggle to maintain their standard of living if you're no longer there to provide for them. Retail therapy, or the practice of shopping to improve one's mood, is a common behavior that can lead to financial problems if not kept in check. Emotional purchases, made on impulse to satisfy a temporary feeling or desire, can add up over time and strain your finances. While it's normal to make the occasional impulsive purchase, relying on shopping as a way to cope with stress, sadness, or boredom can lead to chronic overspending. This behavior not only reduces the amount of money available for savings and investments, but can also lead to the accumulation of debt, especially if purchases are made using credit cards. To avoid the pitfalls of retail therapy and emotional spending, it's important to recognize the triggers that lead to these behaviors. Instead of shopping to cope with emotions, try to find healthier and less expensive alternatives, such as exercising, spending time with loved ones, or engaging in a hobby. Additionally, implementing a cooling off period before making a purchase can help you avoid impulsive decisions. For example, wait 24 hours before buying anything that isn't a necessity. This gives you time to reconsider whether the purchase is truly necessary. Lifestyle inflation, also known as lifestyle creep, occurs when your spending increases in proportion to your income. As you earn more money, you may be tempted to upgrade your lifestyle by buying a bigger house, a nicer car, or more expensive clothing and gadgets. While it's natural to want to enjoy the fruits of your labor, allowing your expenses to rise alongside your income can prevent you from building wealth. The danger of lifestyle inflation is that it can lead to living paycheck to paycheck even as your income grows. Instead of using the extra income to save, invest, or pay off debt, it gets absorbed into higher living costs, leaving you no better off financially than when you were earning less. To avoid lifestyle inflation, it's important to be mindful of your spending and prioritize saving and investing as your income increases. One effective strategy is to maintain your current standard of living even as you earn more, directing the additional income toward your financial goals instead of spending it on lifestyle upgrades. For example, if you receive a raise, consider increasing your contributions to your retirement account or building your emergency fund rather than splurging on luxury items. Tax deductions and credits are valuable tools that can reduce your taxable income and lower your overall tax bill. However, many people either overlook these opportunities or fail to keep accurate records to support their claims, resulting in higher taxes than necessary. Deductions reduce your taxable income, while credits directly reduce the amount of tax you owe. Common deductions include mortgage interest, student loan interest, charitable contributions, and certain medical expenses. Tax credits, such as the Earned Income Tax Credit or the Child Tax Credit, can provide significant savings, especially for families and lower-income individuals. Filing your taxes incorrectly or failing to use effective tax strategies can result in overpaying your taxes or facing penalties from the IRS. Common mistakes include failing to report all sources of income, claiming incorrect deductions or credits, and not filing on time. One of the most common tax filing mistakes is not taking advantage of the tax brackets to optimize your tax rate. For example, if you're close to the threshold for a higher tax bracket, consider strategies to defer income, such as making additional retirement contributions to stay in the lower bracket. Similarly, if you're expecting a significant increase in income in the future, consider accelerating deductions or income into the current year to take advantage of a lower tax rate. Another common mistake is not filing quarterly estimated taxes if you're self-employed or have other income that isn't subject to withholding. Failing to make these payments can result in penalties and interest charges, which can add up over time. Avoiding common money mistakes is crucial for building and maintaining wealth over the long term. By being mindful of these potential pitfalls and taking proactive measures to avoid them, you can protect your finances and set yourself up for success. Remember, financial security isn't just about how much money you make. It's about how well you manage and protect the money you have. By making informed decisions, staying disciplined in your spending and saving habits, and seeking professional advice when needed, you can avoid costly mistakes and achieve your financial goals. I hope you found this video helpful. Before you go, don't forget to check out my other videos. See you in the next one.